Let's get some hot picks in mining. We're joined by Cole McGill, Director of Mining Equity Research at Stifel. Great to see you.
Good to see you too, sir.
Thanks for joining us. We'll start off with copper. The market looking tight?
I think it's increasingly looking tight.
Oh,
right?
okay.
It's 2026 is still forecast to be a bit of a surplus year, only by around 85,000 tons or so. But if you think about that in perspective, that's just 2 months or 8 weeks of Grasberg, which is the largest copper mine globally of supply, right? And you've seen Grasberg have some supply issues over the last month. You've seen Kamoa-Kakula, which is Ivanhoe's asset, have some supply issues in the first half of this year. So it doesn't take much to turn what looks like a small surplus into a bit of a deficit into 2026.
And these giant mines, they're going into deeper rocks, lower grade, and that puts up their production costs.
Yeah, and Andrew, this is something that we've spoken about a number of times, right? It's the kind of legacy asset thesis that we've seen globally, which is kind of causing a lot of majors to kind of rethink and say, hey, maybe it's cheaper at this point to buy versus build. You're seeing capital intensities for assets increase because assets are becoming higher capital, lower grade, higher operating costs, right? In 2020, or excuse me, in 2000, or 25 years ago, the average grade of the top 20 copper mines was around 1.3%. Now that's sitting at around 0.76%, or almost a 50% decrease, right? So assets are getting deeper, they're getting lower grade, they're getting more expensive to operate. So companies like Anglo, like Teck, like BHP, like Teck, are looking to potentially backfill that supply with buying versus building.
Your first idea here, Taseko Mines, this company is going through something of a metamorphosis?
Yes, and as a geologist, that's a fun word to use. It's interesting because if you look at kind of where Taseko is right now versus where it's going to be in 2 years, it's difficult to find significant copper growth within the Canadian mid-caps, right? Whether it be Teck, whether it be Hudbay, whether it be Lundin, all have growth assets, but none have fully sanctioned those assets. The difference with TKO is they're executing on a build in their Florence Copper project, which is in the U.S. It's a SXEW asset, it's a cathode asset, so it's going to be able to produce cathode production into the U.S., which could potentially benefit from the COMEX premium that we've seen over the summer. And that's going to increase copper production for the company by around 90% and decrease costs by around 10% towards 2027.
So this will produce a high-grade product, in other words?
That's correct. So instead of producing a concentrate, which would then have to be shipped to China, Japan, somewhere in East Asia, it's going to produce a cathode, which is effectively raw 99.39s metal, which can then be consumed by the U.S. consumer within the U.S.
How do they do that?
It's effectively SXEW, or solvent extraction electrowinning.
Of course, yeah, they're getting it out,
Similar to what BHP, similar to what a lot of the producers in Arizona use.
That's interesting, like the uranium mining in Kazakhstan, I guess.
Exactly, right? And I think that's the opportunity for investors is the market's still divided on the asset because it will be the first unconventional in situ leach project. But if you look at the valuation for the project right now, if you take out what Gibraltar, which is their other assets being priced in at, you're only paying around 40 cents on the dollar or 0.4 on a PNAV for that asset at spot. So if you think about some of the other development projects in riskier jurisdictions that aren't fully financed, that aren't with an operating portfolio, it's actually pretty good value, despite where the stock is right now.
And there's Gibraltar mine in BC.
That's correct.
ATEX Resources, you reckon this is the biggest copper discovery in the last decade. Where is it?
Yep, so it's in Chile. It's in a higher elevation portion of Chile, and investors will recall the recent Lundin BHP acquisition of Filo Mining, which was back in August or July of 2024. This is a similar type deposit, and what I like about this deposit and what I like about management is the secret sauce in exploration is having a higher discovery rate and having good access to capital because it unlocks growth. ATEX has both of these, right? They've got the right backers. They've got a strategic investment from Agnico Eagle Mines, one of the largest Canadian gold producers. And they also have one of the most efficient exploration teams within South America. They add metal on $1 or on a metal added per meter drilled basis faster than almost any other explorer in Chile. So in terms of the asset, you're trading at around 2 cents a pound, which gives you kind of good downside protection, and they're going to be producing a new mineral resource estimate within the next month or so, which I think has the potential to be a game changer for the company because you're adding tons at higher grade and higher elevation, which is easier to develop and adds more competitive tension for the company.
And there could be acquisition possibilities here if they get taken over?
Yes.
Okay. And then Omai Gold Mines, we talked to the company just a little while ago. It's at BNN Bloomberg.ca, and they're in Guyana.
Yeah, and so what I like about Guyana is it's the same geology and it's the same rocks as what you see in West Africa. It's part of the same shield. But it's
the continents used to be joined, you mean?
Exactly, exactly. And you've seen continental drift pull those apart, but it's the same geology, the same rocks, the same potential. There's only been 20% of gold production within the Guyanese Shield as there's been within West Africa. So what that means is there's higher discovery rates, you have the same fertility, and you have decent drilling costs. So that means better discovery rates, and effectively it's the kind of closest intimation towards kind of return on invested capital for exploration companies.
And MI, though, is still in the development stage?
It's in the development stage, but what kind of sets it apart is it's a prior producing asset. It was operated by Cambior and Northern Star between 93 and the early 2000s, and it produced 3.8 million ounces of gold. It was South America's largest gold mine previously. Shut down because of $300 per ounce gold, but now you've got, $3,700 per ounce gold. You've got access to infrastructure. You've got interim environmental permits. And you've got an asset that just put out one of the larger development resources that are higher grade within the Americas. For perspective, the recent resource they put out back at the end of August was 6.5 million ounces, almost 2 grams per ton. There's only 7 development stage assets that aren't owned by a producer within the Americas that are over 5 million ounces and 2 grams per ton. So they're kind of knocking on the door of being in some pretty scarce and valuable territory for a development company.
And how's the buzz in mining right now with this record high gold price?
It's fantastic. I was just down at Beaver Creek. Denver Gold Conference is going on right now, and the sector's back with the enthusiasm it hasn't had in a while. So it's pretty optimistic at the moment.
We will get, of course, a lot of companies able to say, well, more rocks are becoming economic with this higher gold price.
Yep. And I think that's one of the interesting things, too, is if you look at whether it be copper producers or gold producers, on the gold production side, the major producers that aren't above 4 million ounces or so, which is effectively the Newmonts and the Barricks, which have shown that it's difficult to kind of operate at that 4 million ounce treadmill.
Yeah.
So lower than that, like your Kinross, like your Agnico, like your B2, for instance, all those kind of mid-cap producers between 300,000 ounces and 1 million ounces per year. Those are going to generate anywhere between 40 and 46 billion in free cash over the next 3 years. They're all going to be net cash, so you're going to have a completely better balance sheets than you've had over the last 15 years or so, right? Mm-hmm. So what's interesting is if you look at the last cycle, there was around a 4-year period between when companies took their build teams off assets and went to new build assets. Right now, we're in a bit of a digestion phase. You think about Cote, you think about Valentine, you think about Artemis all ramping up assets within Canada. Mm-hmm. There's potential that investors could say, hey, balance sheets are better, the gold price is remaining relatively stable, deleveraging is happening faster. What's the next leg of growth that's going to surface value? So I think that's kind of the case for the mid-caps like an Omai or like some of the development assets that have scalable assets, open pittable permits and infrastructure. Because at the end of the day, what's the ultimate killer of value in mining? It's time. If you can de-risk time, you can pull forward production and pull forward your cash flow.
Thanks very much, Cole. Cole McGill, Director of Mining Equity Research at Stifel Financial.